Almost everything technicians use in plotting a specific security is either the price itself or a statistical variation of it. Volume can offer a new dynamic in our interpretation of crowd psychology. Analyzing volume trends therefore gives us a better understanding of how and why many technical concepts, such as price patterns, work. In effect, the study of its characteristics gives us greater depth to the weight of the evidence approach described earlier. Remember, volume not only measures the enthusiasm of buyers and sellers, but is a totally independent variable from price. In this module, we'll discuss some general principles of volume interpretation. First, I'd like to say that most of the time, volume is not telling us very much. But when it does speak, there are three major benefits. First, when price and volume patterns are in agreement, the probabilities favor an extension of the trend. 2. If price and volume disagree, it tells us that the underlying trend is not as strong as it looks on the surface. If a breakout from a price pattern develops with a disagreement between them, a warning of a potentially invalid signal is given. And 3. When price is saying nothing, volume occasionally literally speaks volume. For example, price action might offer mild signals of a trend reversal, but volume throws up characteristics of its own that literally shout the message of an impending trend reversal. In such cases, a study limited to price action would fail to uncover a really good and obvious warning or opportunity. 1. The first and most important principle is that volume typically goes with the trend. In a rising market, it's normal for activity to expand, and in a declining one, to contract. In this sense, volume is always interpreted in relation to the recent past. It's of little help comparing 21st century 1 billion plus share days on the NYSE with the early 20th century levels of 5 to 6 million. Such a comparison reflects institutional, not psychological changes. Volume is higher today due to more companies being listed, the advent of derivatives, lower commissions, and so forth. On the other hand, a 3 billion share day this week, compared to a recent 1.5 billion share day last week, is relevant because it shows a significant change in activity, where institutional changes will be non-existent. We know that when prices move in trends, this is not accomplished in a straight line. Instead, in a rising trend, for instance, the price works its way up and down in a zigzag fashion. Volume trends are similar. In the left-hand side of the diagram, for example, the arrows indicate an expanding volume trend. It's apparent that the level of activity does not expand in every period. There are quiet periods and active ones, but the general thrust is up. When we talk about volume rising or falling, we're therefore mostly referring to its trend. Volume trends like price can be intraday, short, intermediate, or long, depending on the nature of the chart. The amount of money flowing into a security must always equal the amount flowing out. This is true regardless of the level of volume. Consequently, it's the level of enthusiasm of buyers or sellers that determines the course of prices. If buyers are bullish, they'll raise their bids until their demands are satisfied. If sellers react to bad news, they might panic, pushing prices down sharply. But at all times, the amount of a security being sold is always equal to that being purchased. If the trend of volume goes with the price trend, rising volume and price is a normal state of affairs, just as falling prices and contracting activity is customary. This combination indicates that things are in gear. Such a state of affairs has no forecasting value, except to imply that it's likely that a negative divergence between price and volume lies ahead. 2. Rising prices accompanied by a trend of falling volume is abnormal. It indicates a weak and suspect rally, and is a bear market characteristic. When recognized, it can and should be used as a piece of evidence pointing to a primary bear market environment. A security where volume shrinks as prices rise does so because of a lack of selling, rather than sponsorship from the buyers. Sooner or later, the trend will reach a point where the sellers become more motivated. After that, prices will start to pick up on the downside. One clue is provided when volume increases noticeably as the price starts to decline. Here you can see that volume starts to pick up as the price begins to sell off. In such situations, it's not necessary for volume to expand throughout the decline, as in this example. It could be that it picks up for 2 or 3 bars just after the peak. In fact, this would be a more typical situation. One of the problems with volume on intraday charts is that it's clustered around the opening and closes. This hourly chart of Amazon highlights several of these days with the orange inverted V's. One way around this is to take an 8-hour moving average, so it covers the complete session and gives us a truer picture of what's really happening. Now you can see that these dashed red arrows point up a weak technical structure as the price is rising but the volume's declining. Finally, we see a situation where the price is declining and volume expands, another abnormal and bearish character. This diagram shows how the volume configurations change between a bull and bear market. On the left we see the normal volume characteristics as volume and price move together. But on the right-hand part of the chart, it's a bear market, and the two move in different directions. Now, I don't want to give you the impression that you'll see these changing characteristics for every security, because you won't. The point being that if you can spot them, then you have some additional pieces of evidence that will point you in a bullish or bearish direction. 3. Volume normally leads price during a bull move. A new high in price that's not confirmed by volume should be regarded as a red flag, warning that the prevailing trend may be about to reverse. In this example, the price peaks at point C, yet the average volume reached its maximum around point A. Such action is normal. The declining volume peaks, warning of underlying technical weakness. Unfortunately, there are no hard and fast rules about how many divergences precede a peak. Generally speaking, though, the greater the number of negative divergences, the weaker the underlying technical picture. Also, the lower the peaks relative to each other, the less enthusiasm being generated, and the more susceptible the technical position becomes once buying dries up or selling enthusiasm intensifies. A new high accompanied by virtually no volume is just as bearish as a new price high with virtually no upside momentum. 4. Parabolic exhaustion moves. Sometimes both price and volume expand slowly, gradually working into an exponential rise with a final blow-off stage. Following this development, both volume and price fall off equally sharply. This represents an exhaustion move and is a characteristic of a trend reversal. The significance of the reversal will depend upon the extent of the previous advance and the degree of volume expansion. Obviously, an exhaustion move that takes 4 to 6 days will be nowhere near as significant as one that develops over a matter of weeks. This phenomenon is termed a parabolic blow-off. Unfortunately, exhaustion or blow-off moves, such as this, are not easy to define, in the sense that it's possible to construct clearly definable trend lines or price patterns, etc. For this reason, it's not usually possible to spot the terminal phase until a period or so after volume and price have reached their crescendos. Newmont Mining offered us a great example of this concept at its 1987 peak. A selling climax is the opposite of a parabolic blow-off. It occurs when prices fall for a considerable period of time at an accelerating pace, accompanied by expanding volume. Prices typically rise after a selling climax. The low established at the time of the climax is unlikely to be violated for a considerable time. A price rise from a selling climax is by definition accompanied by declining volume, though in some cases volume continues to expand for a few bars after the actual low has been seen. This is the only time when contracting volume and rising price may be regarded as normal. Even so, it's important to make sure that volume expands on subsequent rallies, as shown here. The termination of a bear trend is often but not always accompanied by a selling climax. Having said that, it's important to note that in many instances the selling climax after an intervening rally is followed by new lows. Another principle is to monitor the activity when a price is testing a previous low. Here we see the price advance following a long decline and then react to a level at, slightly above, or marginally below the previous trough. It's a bullish sign if the volume on the second trough is significantly lower than the volume on the first. There's an old saying on Wall Street, never short a dull market. It applies very much to this type of situation, in which a previous low is being tested with a very low level of volume. This indicates a complete lack of selling pressure. A downside breakout from a price pattern, trend line or moving average that occurs on heavy volume is abnormal and is a bearish sign. When prices decline, it's usually because of a lack of bids, so volume contracts. This is normal activity and is not giving us much information. However, when volume expands on the downside like it does here, it's because sellers are more motivated, so the decline, other things being equal, is likely to be more severe. An anemic rally on heavy volume is bearish. In this example, the price has been rising for a while, but an anemic rally accompanied by high volume indicates churning action and is a bearish factor. An example is shown at the 2007 peak for Coca-Cola. Note how the final rally is accompanied by very heavy volume, but the price does not make much progress. After the peak, volume expands to an even higher level, confirming that stock was moving from strong into weak hands. The high was not exceeded until the spring of 2011. Heavy volume that fails to push prices lower after a decline indicates accumulation. This diagram shows price action after an extended decline. See how the trading range is accompanied by a substantial pickup in activity. This kind of action with little price change is indicative of accumulation and is normally a bullish factor. Record volume coming off a major low is usually a very reliable signal that a significant bottom has been seen. This is because it indicates that an underlying change in psychology has taken place. Such reversals in sentiment are usually of a primary trend magnitude. One example in the US stock market developed in March of 1978. This chart shows two subsequent instances, in 1982 and 1984. As you can see, both were followed by primary bull markets. Record volume also developed in October 1998 and at the 1987 bear market low in bonds and eurodollars. But it's not an infallible indicator, because record volume was also achieved in January 2001 for both the NYSE and the Nasdaq. Yet this did not turn out to be the final low for the bear market, but merely an intermediate bottom. Sometimes an arrow reflecting the price and volume patterns literally takes the form of a circle. Like this. In this instance, the price experiences a small rounding top and volume a rounding bottom. This is a double abnormal situation, since price is rising and volumes falling as the peak is reached. During the decline, price declines and volume expands, which is also abnormal and bearish. An example featuring Microsoft is shown in this chart. First, note how the volume is weak at the peak, thereby indicating a very fine balance between buyers and sellers. Note also how the letter N characterizes the price action, whereas the volume configuration is closer to a letter U. When the price volatility shrinks to almost nothing and volume does the same thing, this indicates total disinterest. When a situation is finally resolved, this is often followed by an above-average price move. In this example, volume falls to the kind of levels where the slightest movement in either direction will signal a dramatic price movement. In this case, the trend line is violated on the upside and volume explodes. So too do prices. After an advance, exceptionally heavy volume that cannot raise prices is called churning, and it's bearish. In this diagram, we see an advance followed by a trading range. Nothing special here. However, if I increase the level of activity to an exceptional level, this becomes a bearish scenario. This is churning, and it's a sign that smart holders of the security in question are selling to weaker ones, usually under the cover of perceived good news. Not surprisingly, prices fall. Summary for volume. Volume is a totally independent variable from price. It's normal for volume to go with the trend. When these characteristics are present, they have little forecasting value. When volume trends are moving the opposite direction to price, this is abnormal and either warns of an impending trend reversal or emphasizes the significance of any breakout. And finally, volume trends experience exhaustion phenomena. These are called parabolic blow-offs at tops and selling climaxes at lows.